Chuck Carnevale. I'm the Chuck in the Markets Up Chuck. And the Weekly Trader section in Barron's Magazine did a piece on waste management. And every time I read an article like that or look at an article like that, I always like to go and put the company that they're talking about into the perspective of our fundamental research analyzer tool. And waste management obviously is a very interesting picture when you look at it, because it really does give a great deal of insight into some of the principles that I often talk about. First is that earnings determine market price. You can see that waste management has had a pretty decent earnings record. It's averaged about 17.9%, but it's been somewhat lumpy. There was a period here starting from 1990 all the way through 98 where earnings were very strong, and of course the stock price followed suit. The stock price went from 5 and peaked out at around 60 here at the top. Then there was a couple of years of poor earnings and the stock price collapsed, and of course that was during 1999 and 2000, but keep in mind this had more to do with waste management's own operating results than it did the actual rational exuberance of the marketplace. Then, since calendar year 2000, earnings have been decent, but not necessarily great, but the company's stock price, as you can see, has clearly followed suit. They did start instituting a dividend, back in the late 90s, and today you can buy this company with a 3.9%, almost a 4% dividend yield, which is very, very attractive, relatively speaking. When you look at the track record of the company, they've done, very well and consistent with their growth rate, given, valuation considerations. But since 1998, when they started their dividend, their dividend has increased, almost every year. That not, when they first started the dividend, it did increase the first year, but then, it went back down to a penny in 2001 and held the same. But then they paid some really nice dividends and really started what I'd call a real dividend program about 2004. But you can see the company's averaged about 9.2% during a time when the market's only done 6.6. That's over a 20-year period here. But this light blue shaded area shows the amount of dividends being paid out of earnings. And as you can see, their dividend is well covered, and their payout ratio is what I would say acceptable. Now, a competitor of theirs that I think is worth looking at is a company that is much smaller. This is a $14 billion market cap company. It's a company called Waste Service. I want you to notice that their earnings record has been really abysmal, even though they're in about the same business but in slightly different markets. And this company has lost almost 18% a year compounded, and this is only a 12-year chart here, because this is, again, a younger and smaller company, but they did significantly worse than the market itself. But again, look at the importance of earnings and what earnings really mean to the companies long term. And then in the Barron's article, they mentioned Republic Services, which is a, I'd say a more reputable competitor and very similar in size, about a $10 billion company. And look at the relationship to earnings and market price with Republic Services. You can see the stock price, which is the wavy black line here, is correlated very strongly to earnings, just like Waste Management. They instituted a dividend. Yields about 2.9%. I do want you to notice starting out here some overvaluation, but they had about an 11% growth rate, and due to overvaluation, their track record during this time was about 4.4%. But I want to show you a little trick here. If I lop off 2 years off of this chart and make this an 11-year chart, I want you to see what happens. You're dealing with the same company. The only thing that's really different is now the stock price is undervalued during the starting, of the 11 years versus being overvalued. Now, the growth rate during this period is slightly less because the impact of the recession was worse. So you have about a 7%, long-term rate of return, but you start out with growth rate of earnings. So you end up with a lower growth rate of earnings, but buying the stock on a better valuation. And look what happened to the shareholder returns. You get 11.3%, and that's in contrast to a market that was compounding at -3%. So, compounded return of 11% a year during this 11-year period is actually very attractive, and it's higher than the earnings growth rate because the stock was, undervalued at the time, but yet the price still clearly correlates to earnings. It all comes down to, buying earnings at the right value, but earnings ultimately will determine the market price in the long run, and then the valuation you pay to buy those earnings is going to have a major impact on the rate of return. This is Chuck Carnevale. I hope this gives you some additional insights and some look at some other companies. Both of these companies, Waste Management and Republic Services, are probably reasonably priced today based on at least the fundamental charts, and are worthy of maybe some further research if you are of a mind. As I always say, do your own work, but here's a couple of examples of some companies with some decent dividend yields in industries that are definitely going to have a long-term future as the world population grows and waste retrieval and disposal becomes more and more vital. This is Chuck Carnevale saying thanks for listening.